Hello and welcome to High Five. This is Michael Long from the Kaplan CFP staff faculty. I'm glad you're tuning in and using the High Five sessions as part of your study plan. I hope you're finding them to be helpful just to give you a few more ideas, a little more perspective on items within topics that make for great exam material, and certainly some of the things we're able to share with you that we've seen tested before. So in this session, we're going to focus on retirement savings and income planning. And as always, feel free to submit questions as perhaps even as you're viewing this. We'll be happy to help you. You can send them directly to me, michael.long@kaplan.com, or through your instructor link service on the dashboard online. And if you do that, just as always, put high five in the subject line, and they'll know to route that directly to me. If I need to get one of our subject matter specialists involved, I will do that. A lot of the times I can just handle the questions very, very quickly for you. So again, this session, if this is the first session that you're tuning into, these are different than the classes that you will have attended at Kaplan. It's far more casual. I simply share my desktop with you, and in each session of High Five, I have pulled various pages from your review books just to focus on some testing applications. And the whole goal of this is what I describe as the bridge from academic knowledge to financial planning application. You've heard me say before in other sessions that most folks have felt that the CFP National Exam has been one of the hardest exams they've taken. And I think the reason for that is it's the first exam for a lot of folks where it's almost entirely based on application. It's not an academic test like we might see with securities registration exams or insurance licensing exams, which are completely academic recall exams. So CFP kind of starts out with the understanding that you know your academics very well, but the way the board's going to test us is, do you know how to apply those academics in a financial planning scenario? So that's what I want to try to focus on in these sessions. And there's my friendly reminder. You've heard me say before that if I were planning to sit for the national exam, I would read the standards of professional conduct at least once a week. There are so many questions that those standards touch directly from the material itself, but also perspective in the steps of the financial planning process for all of those questions on the exam that say, what does the planner do next? Well, those are typically questions applying the practice standards that you'll find in the standards of professional conduct. So I'm going to keep reminding you in hopes that you really take that material seriously. And of course, my disclaimer here that any of the 72 topics on the CFP Board Principal Topics list is fair game for the exam. Please do not think that the only topics from a particular book that you'll see tested are the ones I've chosen for High Five. That's simply not the case. So I want to continue to encourage you to read review books 1 to 6 cover to cover, make notes, make flashcards, do highlights. Make sure you work every single practice question that's embedded throughout the sections of the book, and then there's some really good make you think kind of domain steps in the process questions at the end of each of those books. So I sure hope that you're taking advantage of that and taking seriously the need to work those books cover to cover. So there's the topic list from CFP Board. We'll touch a lot of these in this session. And then some of them have been covered in other books. For instance, Medicare and Medicaid are really part of our book 2, and I talked a little bit about that in that session in the book 2 recording. So same way with business succession planning there at the bottom. I think that's covered in the insurance book as well. But we'll have a couple of things on each of these moving today. Diving into the book. This page is actually toward the end of the book, but it really is the nature of a lot of the questions touching retirement on the national exam test the which plan should we choose? What's the best strategy? And so we have to really lock into what's being described as the client objective or goal for having a retirement plan. A lot of these questions center on a company, an employer sponsoring a plan. But even on the individual side, there could be selection choices to be made. So I want to start here, and then we'll get into some other ideas in the book. But like you've heard me say with all of the CFP exam questions, we really have to focus on what are they trying to accomplish? What's the benefit to the client? What's the goal or the problem that's being communicated in the question narrative or the case facts? And we just want to lock onto that and evaluate the 4 answer choices you'll have through the lens of that objective or problem. Otherwise, it can often seem like the questions are really subjective, but that gets eliminated the more locked in you are to the goal or the problem that's being reviewed in the question. So as we look at selecting plans, there's a way to kind of break this down to make it a little less intimidating. There's a lot of information in the retirement books, and it's just got a lot of moving pieces, and unless you work with that every day, it can be a little intimidating, but not if you break it down into manageable pieces. Now I just wanted to pull this up again. I went through for the most part the entire tax tables that are going to be provided for the national exam. I got into that deeply in the session on income tax planning, including the notes that I show here. So I don't need to revisit those in this session, assuming you'll also listen to the income tax one. But I put these pages in here. They will be updated by CFP board. You see here, these are 2016 numbers. That's okay, because these are things you're not going to memorize anyway. The discussion is more about how to use this information and what kind of questions might be sourced from any piece of this information. And I've got some pieces for you today where the numbers are already updated. But just the message here is remember how much is provided for you, because you don't have to memorize that stuff, and I want you to get familiar with it now so that you know come exam day where to find certain pieces of information. So I posted this up front here in this session just to remind you what's already provided. All of those inflation adjusted and adjusted numbers are nice. Then on another page you have, as you see here, Social Security items. I will touch on this again today toward the end of this session. So don't forget about this stuff and just get familiar and have it out. I would print it and have it handy every time I sit down particularly if I'm going to do quizzes or a case study. And then the information from CFP board will appear as a drop-down tab for the exam, and you have access to it at all times. You could open it up if you need to check something. So what I want to start with are a couple of pages that are actually in the live review material. Most of you are doing live review with Kaplan, and you'll revisit a lot of this information, both from an application but also some to strengthen some of the academic elements. So I pulled a couple of pages because I like how they're arranged to share with you. So one of the first cuts you want to make with the material is just to try to keep the various plans straight in your head. And one of the ways to do that, because the most plentiful list, of course, as you see there, are the qualified plans. But you're on your way to grabbing test points if you can simply start to remember which qualified plans are defined benefit plans and which plans are defined contribution plans, because a lot of the rules and regulations and maximum limits that come into play for the exam, they're redundant across plan to plan. For instance, in the defined benefit plan, and there's a short list, it's all pensions, right? For example, those are the ones that right now the maximum benefit on the way out of a defined benefit or currently being funded for would be $215,000 a year as an annual pension. Defined benefit plans are the only plans that have PBGC coverage. And then conversely, the defined contribution plans, every one of them on that long list, from the couple of defined contribution pension plans through all the list of various kinds of profit sharing plans, every one of those uses individual accounts, and they're subject to an annual additions limit. The defined benefit plans are not subject to an annual additions limit. The funding is whatever it takes to accrue the promised benefit. So you can start to separate these out based on category. And often in a question stem, it may just say defined benefit. It may say defined contribution. So you're on your way. In the tax advantage plans, note how many of those are funded by IRAs. The SEP and the SARSEP, the funding vehicle, are IRAs. So the only one on that list that's not funded by an IRA are the Section 403B plans. So the allowable investments inside an IRA stay true. The exception to early withdrawal penalties are the same across those IRA funding vehicles. So it just starts to repeat itself, and it's just not as daunting as it might seem at first glance. And then you have a couple of non-qualified plans. We talked about in the insurance session about non-qualified deferred compensation, top hat plans, CERP plans, and then also in book 5, the retirement book, you have section 457 plans, and there's some unique elements with the 457 that make for a couple of great exam questions, which I'll get into today. But break it down, start simple, grab that low-hanging fruit, and try to understand the most basic advantages of the retirement plans listed here, and you're close to getting the points if you can just keep all of that straight, but it just takes practice. The limits in your books have already been updated. It's the CFP board tax tables that they haven't updated yet, but all of the materials you have now in your books and your live review material, they've already updated it, and those are on these pages. So I want you to see this, and you will revisit it. But you start getting into these maximum benefits and contribution limits and what have you. And this is a good summary sheet to keep handy. So talked about the maximum benefit limit in a defined benefit plan, $215,000. That tends to change by maybe $5,000 a year. But then you have the defined contribution annual additions limits. So right now, in 2017, that's $54,000. And one of the questions that can come from this is what is considered in the annual additions limit. And in your books, you may remember from your base courses, there are essentially 3 things that go into that annual addition limit. The most common would be deferrals, employee deferrals, 401k deferrals, let's say. But also employer money. Employer money could be a match on an elective deferral, or it could be standalone profit sharing contributions. And the third thing are forfeitures that are left behind in the plan by a departing participant. And in some plans, in some defined contribution plans, they might choose to reallocate those. So all 3 of those numbers roll up to a maximum limit of $54,000. We don't deal with that in the defined benefit plans because, as I mentioned, it's just whatever it takes. What are we promising these folks? And an actuary every year crunches the number to determine whether the plan is on time, if it's fully funded, and adjusts the contributions each year accordingly. I mentioned in the tax session in visiting some of these, the deferral limits in 401, 403B, 457 even on that list, $18,000. And remember that you may have a test question where they have a 401k or 2 401ks or a 401k and a 403b. That 18,000 is cumulative. So it doesn't matter how many of those plans they're participating in. Overall, they cannot exceed 18,000 as a regular contribution limit. There is one exception to that, which makes for a great exam question, and that's the fact that the 457 deferrals are not aggregated with the 401k or 403b. They actually could put 18,000 in a 401k and another 18,000 in the 457, assuming they have qualifying compensation, of course. You've got various catch-up provisions. And a couple of good exam questions in the catch-up arena come from 457 and 403b. These are different. It's not just the 6,000 a year and maybe the over age 50 catch-up as well. But in 403b, they can certainly do their 18,000, but also that they might be eligible for the over age 50 6,000, and then a special catch-up provision for as much as $3,000. So in the 403b, we could have an exam question where the top end is 27,000. 457 is even more liberal in its catch-up type of provisions, in that in the last 3 years of employment with a 457 plan being sponsored, they can double the contribution. So it could go to 36,000 in those last 3 years. Those two wrinkles make for great exam questions. And then as you read about 457, you'll read that the client cannot take the double 36,000 limit and add the over age 50 in one single year. So that's a good exam question as well. An area that is the source of many questions that come in is in the area of highly compensated employee. It doesn't seem like a tough area, but boy, do we get the questions from it. So of course, you know that highly compensated employee measurements impact the non-discrimination testing, but also it impacts the maximum contributions, the maximum deferrals that could be made in say, a 401k plan, in separating the groups between highly compensated and non-highly compensated. And what I want to point out, the biggest source of these questions is that top 20% election. As you know, if the employer chooses, they can make a top 20% election, and for highly compensated employee purposes, that list would only include folks who rank in the top 20% based on compensation only. And there's the confusing part, because we know with highly compensated, it could be a greater than 5% owner and or one whose compensation exceeds $120,000 is the current number. But the confusing piece is that making the top 20% election will not remove a participant from the highly compensated list if they are a greater than 5% owner. And that's a common exam question where they show someone who's maybe a 6% owner, and maybe their compensation is only $50,000 a year. So you immediately would think, oh, they're not in the top 20%. They are, because they're a greater than 5% owner. For these purposes, the greater than 5% owners will always be in the highly compensated group. There's some good questions in the live review material, and they just get sent in constantly thinking, wait a minute, there's 10 employees on this list. That would mean 20% is only 2. Why do we still continue to include others? Because they're more than 5% owners. Some other of the inflation adjusted numbers, you see down there the Social Security wage base at 127.2 for 2017. You see that the maximum compensation included in the formulas right now is $270,000. That went up $5,000 from last year. And by the way, that can be another source. I may have mentioned this in the other tax session, but the very top line, that $215,000 for a defined benefit maximum limit, that's the benefit itself. But in all qualified plans, the benefit formula cannot consider any more than $270,000 of compensation. We often get questions with confusion between the $215,000 and the 270. One is an actual benefit, one is the compensation limit in all qualified plan benefit formulas. So keep those straight. Also, your Social Security earnings limitation, that has also been added to the provided tax tables. So it wasn't always in there, so I'm still waiting on what kind of questions might show up in the future related to earnings limits and Social Security benefits. But all of those are updated, so that should make it a little easier for you. I also wanted to point out in the back of book 5, and I should just say with all of your review books, make sure you check out what is in the appendix of each of those books, because there can be some good examples, some good charts and tables that could make things easier for you. So these couple of pages are in the back of book 5, and this is how you can start to pick out the nuances. This is a good table to help you break down the selection of the most appropriate plan for a sponsoring employer because of these nuances. You heard me approach the education chart in the first session like this. What sets them apart? What's the main advantage of one plan over another? What benefit are we trying to look for within the plan features? And that benefit would be, of course, aligned with what the client objective is in the narrative that we're given. But this is where that can start, where you start to see in one visual the differences between these plans. And I won't go line by line, but just to give you some examples here. If the employer wants to have employee contributions, which plans allow that? And you see that's the lineup of defined contribution plans, primarily the profit sharing plans, whereas the defined benefit pensions and the defined contribution plans are funded 100% by the employer. So you start to distinguish between the plans in that manner. One of the areas that can come up in the case or question narrative is that they would like to make contributions in some amount using employer stock. And so that's one of those red flags that should go up for you. If they start talking about employer stock as a contribution, understand that if they're really serious about that, we're going to give the nod to some type of profit sharing plan, because a profit sharing plan could be funded 100% with employer stock, whereas the pension plans, the defined benefit pensions and the two defined contribution pension plans, it's limited to 10% in employer stock. So that's another flag for you, another alert for you. Sliding down a ways here to leverage borrowing to purchase company stock, and that's what I would be looking for in the question stem, is wording very similar to that. You can go across the whole list, and the one that we see there is the ESOP. That one can employ leverage, borrowing in the name of the plan to fund the plan. No other plan allows them to do that. Because students might say, well, what's the difference between a stock bonus plan and the ESOP? Well, they're both can be funded primarily with employer stock, but only the ESOP could use borrowing, could use leverage. So that would be kind of the final knockout if we've got it that narrow. What else down here? Integration. You could see a question on just which plans can use integration, and I've got that highlighted there, and one of those is the ESOP that cannot. That and an existing SARCEP. Now, no new SARCEPs can be established today, but there are plans still out there that are active, and that's why you'll see information in your materials about SARCEPs, is because they're still being administered out there. What the employer can do with forfeitures is another good detail to remember, because that could help distinguish between your last two choices. It's just a nice chart to practice with. Students have told me that they will make a copy of this page but cover up all of the check marks and all of this other information, and then just see how much of it they can fill in on their own. That's a pretty good exercise, I think, as well. And then there's a second page of these summaries as well. So just drawing your attention to it today in hopes that you'll go find this and work with it. The top line here on this second page was the PBGC, and you can see the only two things highlighted there are the defined benefit, the traditional defined benefit pension plan, and then over to the cash balance pension plan. And then just again, you'll start layering in more and more details that hopefully give you that foundation to eliminate 3 of the 4 answer choices. If you have any question on this as you get into it, that's a good thing to send in and get some dialogue going with us. Another feature that you'll evaluate is in the question narrative or case, it might describe whom they wish to benefit most in this plan. And honestly, a lot of it comes out to be the owners, and often the owners are the oldest participants on the census. So there are some plans that could favor older participants, particularly at onset. Certainly the defined contribution, traditional defined benefit pension plan is one that immediately lights up if we're looking at benefiting an older ownership group, because of the fact that they can define the benefit and then they have to fund it with however much is necessary to deliver that benefit at retirement. So if an older owner is coming in at 55 or 60 years old and the normal retirement age is 65, they can put a ton of money into that plan for those, usually owners. Another thing we could do is use age weighting. We could go the profit sharing route, but use age weighting, which just simply uses a discount factor to come up with an age weighted contribution. So it's another way to skew the majority of the employer contributions to those older employees that they want to benefit. Also, in the red box notes here, there's a question in the question pool about the employer wants to do something with a plan, but the year has already ended, but they really want to do something. Well, the red box note is just simply that the CFP plan is the only one that can be established and funded up to the date, the required tax return date, including any extensions. You can establish qualified plans throughout the year and then fund them by the tax due date, but a qualified plan must be established before the end of the year. Unlike the CFP, we could go clear out and fund that, establish it and fund it later. So other things you're looking to pick off in the question stem and the cases are if there's any information given about how the sponsor feels about these different elements here. It may tell us in the narrative that they really don't want to have a plan with a lot of administrative expense. Well, a defined benefit plan has a lot of administrative expense. Anytime you involve actuaries, you have a much higher expense to administer the plan. So we're sensitive to that. We might be given information in the question that the employer is uncomfortable taking on the investment selections and risk for the plan, which again would eliminate from the answer choices the defined benefit plans. So they want the employees essentially to manage their own accounts. Well, all of the defined contribution plans allow that. So we could probably eliminate at least one answer choice because one of them is probably going to be defined benefit with that kind of feature. And then on the flip side of that, sometimes you get an emphasis on the employer wanting to provide guarantees. They want their folks to be absolutely guaranteed what they're going to get coming out of the plan, and that eliminates the defined contribution lineup, because it's only the defined benefit plans that can absolutely guarantee what the final benefit will be. So as you're reading cases and as you're reading questions, I hope that these things start to jump out at you. It's almost reading every one of the pieces like, why would they be telling me this? Well, it's being used to narrow the answer choices and see how good we are at locking on to aligning the benefits of a selected plan with the benefits sought by the employer sponsor. So we also want to be sensitive there in that last red box note about the census information. What do you notice? Now, typically a standalone multiple choice won't dump a census in there, but case studies are in many cases, and even item sets are good for that, where you can have an expanded fact set. So we just want to get used to picking out how many employees are we talking about here, what are the ages of the people they're describing in this plan, and what's the compensation of these various participants, and what kind of disparity is there? Are they pretty much all even, or is there a huge difference between management level folks and the regular employees? You just become sensitive to picking up on that, as well as years of service, turnover frequency, average tenure of an employee service or participation in a plan. Those answers come into play with you're asked in a question to recommend a vesting schedule. So if you would see in a question where the average tenure of the employees is 4 years, well, we would probably go with some graded vesting schedule, and unless you're specifically told otherwise, we're evaluating vesting schedules from the benefit of the employer typically. So if they have 4 years average tenure, we'd probably go graded, because if we went, say, 3-year cliff, it's a defined contribution plan, and we go with a 3-year cliff vesting schedule, well, the people are, even though they're leaving a year later, they could be walking with 100% of the benefits, whereas with a graded schedule, they would still forfeit something if they leave early like that. So just beware of the trade-offs within these plans. And then what I do with them, you've probably heard me say before what an advocate I am for handwritten flashcards. I just am. I really think there's something to taking the time to paraphrase something or make a note in our own handwriting and our own words of summary. I just think it burns it deeper into our brains. I really do. So this is the kind of thing I did with this information. So here's an example. This is a flashcard, and I just used 5x7 flashcards. And my original goal was I want to have one for every single listed topic. I want to be able to recite at least one thing about each topic. Well, what happens once you get started, there become subsets and there become multiple cards on a subject, but it's just a great start to say, okay, all of them, here's a card. So here's a quick lineup, and you probably can think of even more things you might want to put on a card. But starting off with those maximum benefits, there's that $215,000 limit for the benefit itself, $270,000 maximum compensation. The defined benefit plan has PBGC. It's the one that guarantees the final benefit. The traditional defined benefit pension specifically states what they would receive on a monthly basis. It's the only one that gives it that way. And it does tend to favor older plan entrants because they can use that whatever it takes funding. Usually in a traditional defined benefit pension, the formula is some percentage of compensation. It might be the highest 3 years, it might be the final 3, but it's usually a percentage of compensation times the years of service. And you might have to calculate that in a question or a case study. With the defined benefit plans, they can use either method of Social Security integration, the offset method or the excess method. Defined contribution plans can only use the excess method. Mandatory employer contributions annually. That's one of the things about pension plans. Not just defined benefit, but defined contribution as well. Got to put money in every year. So that could eliminate some of your answer choices. If you read in the choice that they want contribution flexibility, that's got to be a defined contribution plan. And it's going to be a profit sharing plan, because even if the defined contribution plan, or even if the pension, the money purchase or the target benefit is defined contribution, they still have to fund that pension on an annual basis. So we would be looking to the profit sharing plans among the answer choices, and then looking deeper as to define which profit sharing plan best fits the objective here. Because of the mandatory contributions, but even more so, the defined benefit and the actuarial need on a yearly basis. A defined benefit plan has to involve an actuary every year. So that makes it more expensive to administer. Mentioned just a minute ago that in a traditional defined benefit plan, as well as the cash balance pension plan, the employer has the investment risk. There's a trust, and they make the decisions on the investments, and so they're shouldering that burden. Well, one of the items in your fact set might be they don't want to do that. They really are uncomfortable calling the shots on the investments for the plan, so we would want to go defined contribution. Mentioned already, the funding limit on a yearly basis for a defined benefit plan is however much it takes to guarantee those benefits, whereas the defined contribution plans have specific limits, most notably that annual additions limit. And then the forfeitures. We could have forfeitures in either type of plan, but when it's a defined benefit plan, those forfeitures have to then be applied to essentially offset employer expenses, either contribution expenses or administrative expenses, whereas the defined contribution plan could take their pick. They could use it to offset employer expenses, or, and more favorably to the employee participant, they could redistribute the forfeitures on a pro rata basis to the remaining participants. And if they do that, remember then that those reallocated forfeitures become part of the annual additions limit when we're applying the maximum. So all kinds of stuff that you could put, just little, nothing here is even a complete sentence, just a few words, but the goal here is it just triggers your memory on deeper detail with all of these things. And then I developed the attitude that every one of those bullet points that I put on a flashcard becomes a potential question I can answer. And I don't know how many are here, maybe 10 or 12. But I just developed the attitude, bring it on. I've got 15 things on my card that I could answer about a traditional defined benefit plan. Bring it on. What do you want to ask me? Now, the good news is you're not going to have 12 or 15 questions about traditional defined benefit pension plans. But when you can recite these kind of things, it really gives you a great probability of getting all the points that for questions they might ask you about any particular item on your flashcard. I kept them with me. The whole time years ago that I was studying for CFP, I carried a backpack, and I would take these 5x7 cards and punch a hole in one corner and put them on one of those steel rings you can get at Staples or somewhere, and I always had them in the backpack. So if I had some downtime, whether it be commuting on a train or waiting for an event or something, I could be flipping through flashcards, and I just found them invaluable, particularly down the stretch of preparation. So I'm working on this decision flow, and one day I hope to have this with graphics and boxes and those nice things about flow charts, but this is where it's at right now. And you've heard me say before in other sessions that part of this mentality, this perspective in the CFP materials is to separate the features and benefits of specific financial products or strategies, and then align them with the client goals or problems that are being outlined. Well, retirement really lends itself to that, because there's so many different products we're talking about inside, like the qualified plan arena. There's a lot of different kinds of plans. So it's really critical to be able to break down the features of these individual plans and translate them into benefits for the client. So this is just a simple little example, and it shows knocking out choices based on what's being communicated in the question stem. So if it's pretty big picture at the top, that what we pick up in the narrative is that the employer wants employees to be able to make pre-tax deferrals. Well, you know, 4 things pop up right here that we've been studying. 3 of them being 401ks. Yeah, the traditional 401k, a safe harbor 401k, simple 401k, and then we'll throw in the simple IRA because they can make pre-tax deferrals to that. Doesn't narrow it greatly, does it? But we've eliminated a whole lot of plans just with that one element. But then we would have to look deeper in the narrative of what else are they after by sponsoring a plan. So if that next thing, and it may be the only next thing that's there, is simply employer does not want to make matching or non-elective contributions, we're done. It's the traditional 401k. A traditional 401k could be completely funded by participant deferrals only. I mean, the sponsoring employer would have administrative expenses and discrimination testing and such. But if they don't want to get into any kind of contribution directly to the plan, it's a traditional 401k. As would be the case if in the narrative we're told the employer is willing to match, but they also want to have the longest possible vesting schedule on that match. We're also going to end up picking the traditional 401k because with the safe harbor and the simple 401k plans, there's what? Immediate vesting. There are mandatory matches and immediate 100% vesting, so they can't string it out. So that would eliminate those plans. If one of the narrative pieces is the employer wants maximum elective deferral opportunity, well, we're going with traditional again, or maybe safe harbor, because the simple arrangements have lower limits, don't they, for how much could be electively deferred into one of those plans. But if we're down to traditional and safe harbor, what would separate that last answer choice is some kind of mention about ongoing administration. Even though the safe harbor requires employer contributions, it is less expensive from an administrative standpoint when compared to the traditional 401k. So that's how we would bounce the traditional 401k from the answer choices. Same way with ongoing administration. If that's the primary. So if that's the main factor, we still have a lineup here. Lowest ongoing, simple 401k or safe harbor. But so we would have to be digging for something else, right? And what could tip it in the manner for the simple IRA is they want the lowest possible match, because in the simple, the match can be as low as 1% in 2 of every 5 years. Can't do that in the simple 401k. It can't go that low. So you get the feel for this. Is just what you look at all of those features with that lens on of, okay, what's the advantage to that? And then what's the advantage or disadvantage when you compare it to other kinds of plans that basically can fulfill the same big picture objective. So hopefully this demonstrates for you, starting with a very big broad brush, but then narrowing it down based on these unique features and benefits of the individual plans. Again, it's another one of those things that that with some practice and mindset, you can start to spot the winner from a list of 4 possible choices. And that's the nice thing really about multiple choice questions, isn't it? They can only give you 4 answer choices. So it's one of those 4 is the best. It's not the entire array of products like for education and retirement that can be quite extensive. We're only analyzing the 4 they're giving us. Something that, you know, I think most of us would say, yeah, I know a lot about that. IRAs, been around forever. If you're a financial advisor, it's probably a decent part of your business from time to time. But there are a couple of things that generate a lot of questions from students about IRAs. So I wanted to put a page in on that. And I think I mentioned in the tax session, the fact that in that red box notes at the top there, alimony. For IRA contribution eligibility purposes, alimony is considered compensation. So don't be surprised if you were to see a question where the only income that the taxpayer has is alimony. And the question is, could they do an IRA and for how much? So we'd be looking to cover the full amount. We'd have to have at least that much in alimony for a maximum contribution. But don't forget about that. And also don't forget about the fact that if one spouse has qualifying compensation and the other does not, we can still do a spousal IRA. They could contribute really based on the spouse's compensation. Also, a distinguishing feature is we get into these thresholds, and one of the things that was added to the tax tables, the CFP board tax tables, were these different thresholds. They used to not give us those. So I am expecting over time more and more questions involving thresholds because they're giving it to us now. But for the traditional IRA, remember what's being potentially phased out is the deduction they might be able to take. It doesn't phase out their ability to contribute. If they have the $5,500 of compensation, they can put $5,500 into the traditional IRA. How much of it is deductible depends on active participation in an employer-sponsored plan. And when we get into phase outs, it's possible for the phase out to be partial. So be ready for that. I highlighted here you have the single taxpayer phase out from $62,000 to $72,000. If their compensation is, if they're in active participation and the compensation is somewhere in the middle, we just create a fraction. So if their compensation was $67,000, the fraction is the $5,000 in excess of the initial threshold divided by the spread of the total threshold. So in that equation, if they're at $67,000, we have $5,000 over a total spread of $10,000. Half of the deduction could get phased out, but they could still contribute the maximum amount. But probably the number one source of confusion with these kind of questions comes, well, I'm going to say two things. One, remember that even if they're an active participant, if their compensation is below those threshold limits, they can still contribute the max and deduct it. Just because they're a participant doesn't automatically exclude them from a deductible contribution. It's what their magi is when they are an active participant. All right, so, but the biggest source of confusion tends to be when there is one spouse that is an active participant and one who is not. And so the note that's in here is when that's the scenario, there are two phase-out thresholds in play, separate. In a married filing jointly return, the active participant spouse has a threshold of $99,000 to $119,000. But the non-active participant spouse has a different threshold, and that threshold is $186,000 to $196,000. That's a great exam question because it applies multiple layers of application. And there's a pretty good example there, but big star beside this, because this one we get a lot of questions about as you run into practice questions. Then I also put a red box around E, and I had mentioned this about the fact that Section 457 elective deferrals are not aggregated with elective deferrals to other plans. But another distinguishing feature of the 457 participation is the fact for IRA purposes, Section 457 participation is not considered active participation for IRA purposes, that makes it a great item for an exam question as well. So make sure you give that information a look. Don't just skip it when you see IRAs. And then Roth, a lot of the basic things about Roth are the same. As a traditional IRA, the biggest difference, of course, as you know, is that we don't deduct contributions to a Roth. And a distinguishing feature also is the fact that the phase out, there are modified AGI phase outs in the Roth, but these apply to the ability to make a contribution. It has nothing to do with deductibility like the traditional. It has to do with the ability to even contribute to the Roth account. And if you get one, you get two here with the married filing jointly, the same threshold, 186 to 196. So just remember that. We're talking about phasing out the contribution. And the fact that I highlight this now simply because it hasn't been that long that a participant could do in-plan conversions from a non-Roth account into a Roth account. I mean, it triggers the same kind of taxation, but now they can do them in plan. They don't have to distribute and then convert and all that. So I don't know how many questions, but it takes CFP board a while to integrate questions on things relatively new, but just be ready for that when they can do it in plan. But the biggest source of confusion and questions with Roths is not the contribution piece, it's the distribution piece. And I want you to make these questions gimme. So the whole goal, right, of the Roth, the trade-off is we don't deduct the contributions on the way in, but if we meet a couple of requirements, the distributions can be tax-free, and that's a good thing. So I want you to really think about this. There are two levels of qualification, and that first one is absolute. In every circumstance, we have the first one, and that's that 5-year holding period. Gotta happen, or we'll never have a qualified distribution. 5-year period. And then some great test material on that is the fact that that 5-year period begins on January 1st of the year for which the contribution to the Roth IRA is being made. So you could have a narrative that says, it's April 2017 and the client's making the first contribution to a Roth but for 2016. So for this absolute 5-year holding period requirement, the 5-year clock actually starts then January 1st of 2016. So don't be fooled by that narrative. It's real commonly tested to try to throw you off that way. But then for there to be a qualified distribution, in addition to the 5-year test, one of 4 things must be satisfied. It can be any one of them, but we need to also have this second piece. One is the attainment of age 59 and a half, or distribution due to death of the account owner or disability of the account owner, or for first-time home purchase. Now there's a small limit on that, 10,000 max, but those are the 4 qualifying circumstances, one of which must be met together with the 5-year period to have a qualified distribution. One great source of confusion I see from my chair is this 59 and a half. We're so wired to think about age 59 and a half in traditional IRA or even qualified plan distribution scenarios. Understand that that age 59 and a half is just one of 4 possible qualifying circumstances. It is not a requirement. It's just one possibility, because there are exam questions out there that will give you all the information, and it will tell you, they'll tell you when the Roth was opened. And then the question becomes, what is the first possible year in which a qualified distribution could happen? And in that same question, of course, they would give you the age. Well, what happens is You add 5 years to the age in the scenario and it doesn't reach 59 and a half. And so the student's thinking, hey, wait a minute, they're not 59 and a half. You can't have a qualified distribution. Yes, you can, because death, disability, or first-time home purchase can happen at any age. So the person might only be 50 years old when they opened it, so they will have reached 55 when they satisfy the 5-year holding period. From that point on, any of those three could happen: death, disability, or first-time home purchase. So they could, the first possible year would be the year they have satisfied the 5-year holding period. Really, really common thing that gets sent in for further clarification. So hopefully that becomes very easy for you. But moving on with this, and this is why Roths are rich for exam material. It's possible that a distribution from a Roth could not be qualified. It didn't meet those two tests, the 5-year holding period and one of those other things, but still the distribution could be tax and penalty free. Well, how could that be? It's because for every distribution from a Roth, whether it's qualified or not, the distribution is attributable in this 1, 2, 3 order that I've red boxed out here. The distribution is first considered to be coming from their regular contributions, that $5,500 a year stuff. That's the first thing that gets depleted in distribution ordering. Second is from conversions. So the conversion comes back out tax-free because at the time of the conversion, they pay taxes, right? So that's the second level, and those are distributed on a FIFO basis, first in, first out, oldest ones first. And then the third level of attribution for the distributions is earnings, the returns, the interest. So it's possible, the reason it's possible that a non-qualified distribution could be tax and penalty free is because it doesn't go deep enough into the order. If you have an exam question and they're giving you the amount of contributions and then they tell you how much they're taking out, if it just hits that first level, if it's deemed to all be coming from regular contributions, no tax, no penalty. The second level, if it starts dipping into conversions, the amount deemed distributed from a conversion, that piece is not subject to regular income tax, but if it's attributed to a conversion within 5 years, they are subject to penalty, the 10% early withdrawal penalty, unless some exception applies. So that's a good one. This conversion within 5 years is really a great testing point. So be careful with those, both with the 59 and a half thing and then the distribution ordering. We get tons of mail every year about this ordering and the 59 and a half thing. So make sure you check out those pages and studying them diligently. And then there's some examples here you can work through and see if they connect for you, that lay out dates and amounts, and then you can practice the attribution order. And let me know if it doesn't stick for you. All right, the next thing I wanted to touch on are lump sum distributions. Now you see in this same section in the book, I'm on page 111 right now, there are a couple of other things for lump sum distributions, notably 10-year forward averaging and pre-1974 capital gain treatment. Because these only are available for folks who were born prior to January 2nd, 1936, in practice, they're pretty obsolete anymore. Just kind of know that there's a couple things out there for lump sum distributions, but I don't ever believe anymore that you would actually have to do any calculations applying a 10-year forward average or a pre-74 cap gain treatment. I think for lump sum distribution, if you're going to get tested on numbers and such, it'll be for NUA, net unrealized appreciation. And this comes in to your profit sharing plans. Well, I suppose it could be money purchase or target, but the question will be about profit sharing plan in which employer securities have been used to fund the plan. When a lump sum distribution includes employer stock, there's special tax treatment for net unrealized appreciation. And what that is at the time of the distribution, the NUA is the difference in the market value of those securities and the basis. The employer, what the employer basis to the contribution was. That is NUA. So the way this works is the portion that's NUA is not taxed at the time of the lump sum distribution. It's deferred, that net unrealized appreciation. Now, what is taxable at the time of the distribution is the employer basis, and then that becomes really the employee basis upon distribution because they have to recognize that employer cost basis. And then later, when the stock is ultimately sold, we have this lump sum distribution, there's NUA treatment, they paid some tax on the basis, but they didn't on the NUA. Later they sell the stock, but they will forever only pay long-term capital gain taxes on that NUA portion at the time of the distribution. Doesn't matter whether they hold that stock 3 more days or 30 more years. It is always going to be long-term capital gain. So it can be a pretty strong tax advantage for someone in this situation. Now, another layer of questioning that could happen could be, well, they take the lump sum distribution, they paid their tax on the basis, they didn't pay on the NUA, but since the time of the distribution, it has appreciated further. So how is that treated? So the subsequent growth will either be short-term capital gain or long-term capital gain depending on the holding period that happens after the lump sum distribution. So you'd want to be aware of the dates that they're telling you when the lump sum distribution happened and then when they subsequently sell the stock. And if I were writing that question, I would make that second piece short-term just to force us to know it. That if it were 9 months later after the lump sum distribution and it had appreciated further, that piece of it is short-term capital gain. So you've got a decent amount of practice questions in the material to practice this, and there's some good examples in the materials as well. I like this one because it kind of covers the all of the testing elements in one example. But we have a lump sum distribution of employer stock valued at $1 million at the time of the distribution, and the basis to the trust, the employer basis there was $250,000. So it's distributed. $1 million is distributed. So $750,000 of it is NUA, and the long-term capital gain recognition is deferred. $250,000 will be taxable at the time of distribution as ordinary income. That's a good little side question. The treatment of the $250,000, that's ordinary income. So that becomes its basis in these shares. They could test you on a per share basis, but I doubt it. It'll probably be these full numbers. But then they go on to tell us that after the lump sum distribution, it goes from $1 million to $1,100,000, and that's when he sells the stock. So depending on the holding period subsequent to that distribution, we're always going to have the NUA portion of $750,000, and the subsequent piece would be long-term if held more than 1 year, and then short-term capital gain if it were sold inside of 1 year. That's a great exam question setup. These kind of fact patterns make great item sets, and you'll practice with those. There are 35 really good item sets in Book 7, the case study book. They're right after the 12 case studies that are in there. Do them all. Work that book cover to cover. But item set where we would have all this information, and then they might ask us 3 or 4 related questions just from that information. So this is a great way to lay that out. Then taking it a bit further, and I think what we just covered in the red box is most likely to be where your questions will come from. One more wrinkle that's interesting, but I think less probable, is what happens then later at death. So it extends the example and changes one of the values. We still have the lump sum distribution of $1 million. We had 250 basis to the trust that he paid taxes on when it was distributed, but they've added here that Brian dies later, and it has grown to be valued at $2 million. So we had $1 million of subsequent appreciation after the lump sum. So the basis is a little different. There is no step up in basis for income in respect of a decedent, right? So the 750,000 NUA would be considered income in respect of a decedent. It would not be stepped up, but the rest of that basis would. That $1 million of subsequent appreciation would get a step up. So his basis then the basis to the beneficiary was that original 250 for which taxes were paid on at distribution, plus the $1 million it further appreciated after death. Now that's tough. That's a tough question, but you've got an example there. If you want to play with it and remember it, it could be good for another question. But most of it, as I said, is up here in the starred red box of how NUA would be tested. Just also want to draw your attention to make sure you study the Quadro section here. And really be sensitive and alert to anything involving divorce. I think you will have numerous questions on the national exam pertaining to divorce. So pay attention to that. We've talked a couple of times about alimony. In the tax high five session, I talked about alimony versus child support and how that is treated from an income tax standpoint. But we get into that as well in the qualified plan arena. So take a look at the qualified domestic relations order. Now, the same kind of distribution can happen in an IRA. It's just not called a quadro. Quadro is 4 qualified plans, but you can do essentially the same thing. I get asked that a lot. So quadro is just that by a decree in typically a divorce scenario that a portion of one's qualified plan is distributed for the spouse. So understand how that works and some of the rules. And some one-off questions with that are the fact that that alternate payee cannot force a plan participant to take a lump sum distribution from the plan. That the quadro can be satisfied. But that's probably a less likely question as it is this next one, tax treatment of distributions for a quadro. They can be rolled over so that receiving former spouse, the alternate payee as they call it, can take that and roll it over into their own plan, and in the test question will be an IRA. They can do that and not have any recognition of tax. If they take the money from the qualified plan and they don't roll it over, of course it's going to be taxable. Whatever portion would have been taxable to the original participant, but they can roll it over. So watch for that, because the case involving divorce could center on what can they do with the retirement money, and just know they can roll it over. And distributing the money, the original payee, that distribution does not become taxable or penalized to that person, even though it's being distributed early. So check that out and put all of that type of the divorce stuff on your radar to make sure you're comfortable with what you're reading in these various books. RMDs. Now this is another easy one, right? If you're a financial advisor and working in retirement with clients, you get into RMDs, and it's a pretty simple thing. We take the balance of the previous year, and we have to start, we're required to take distributions when they've attained age 70 and a half, and then we go from there. That's simple stuff. But a couple of things. What age we use seems to come in a lot with questions. It's the age at the end of the year, and for exam purposes, it's of course going to be 12/31, What's their age at that time? That's the factor that we use. And the way that gets split is if they're born in the first half of the year, if they turn, or if their birthday is in the first half of the year and they reach age 70 and a half in the first half of the year, they're going to reach that next age by the end of the year, aren't they? So that's the factor we pick. If they reach 70 and a half in the last part of the year, they're not going to reach 71 until the next year. So we would back that up and use 70 in the RMD calculation, because they're always going to give you like 3 years of ages. So understand that split. But probably more confusing than that in the questions I see is when they choose to defer the first distribution. Somebody reaches age 70 and a half in 2017, but they elect to defer that first RMD as late as April of 2018. Understand that that initial RMD does not lose its character as the RMD for 2017, even though they take it in 2018. So what that means is we calculate it based on the 2017 age and the amount from the end of the previous year as far as what value we're dividing. But then notice that when the client does that, in 2018, they're going to have to take 2 distributions. They have to take their distribution by April for the 2017 tax year, and then they have to also distribute the 2018 RMD. Those cannot be rolled into the next year, so we'd have 2 distributions, so they maintain their character. We get a lot of questions about that, but I think that's good because those are highly probable kind of questions as well. What age do we use for the RMD? And then we're going to defer the first one, so what does that mean? So hopefully you can spend some time with that and get comfortable and make those easy questions as well. There's the highlight for the subsequent year distributions. You've got a lot of practice questions on this, so there's ample opportunity to send them in if you need. There's a good section on distributions from plans at death and what the various options are. Study this whole section. But the one I wanted to stop on today is when it's a spouse, it's a surviving spouse as the sole beneficiary. Understand that in that scenario, that surviving spouse can elect to be treated as the beneficiary or as the owner of the account, and it enhances their options based on, I mean, they have more options just if they choose to be the beneficiary than a non-spouse beneficiary does. Essentially, they're going to have to start distributions in the year following the death. I'm talking about the non-spouse beneficiary. That's a good exam question by itself as well, but it gets a little more advantageous to the spouse beneficiary because they have more options. So if they choose to be treated as the beneficiary, they have to begin then those distributions by the time that the decedent would have reached 70 and a half. They could start the distributions and base it on their own age. But most of the time for exam purposes, they're looking to defer. How late can they wait? But the piece I've highlighted here is the electing to be treated as the owner. They can just make themselves the owner of the account. They could roll it over into their own account, whereas the non-spouse cannot roll it into their own account. It has to be held as an inherited account, but the spouse could just roll it right into their own IRA if they had one. And this, an exam question I really like is a surviving sole beneficiary spouse and the account they're inheriting is a Roth. In that scenario, and the spouse chooses to make themselves the owner, RMDs don't apply for the balance of their lifetime then, just like it wouldn't have applied had they originally owned the Roth account. And I think that's a very interesting wrinkle to this whole inheriting an IRA conversation. So a couple of good notes to make there. Then the last thing I wanted to get into here is Social Security. You will have numerous exam questions on Social Security. So it's one of those, like I've been talking through this series, grab that low-hanging fruit first, but continue to revisit this information so you can absorb more detail. You know your funding on this. You've got the two pieces, the OESDI and the Medicare part. Combined, they're 7.65 for the employee and 7.65 for the employer, or the full 13.3 for a self-employed. You understand that. You understand the Social Security wage base, and there it's been updated for 2017 in the book at 127,200. Pretty big jump from last year, 9,000. That I think is the biggest jump it's taken in recent years, I believe. Then you have full retirement age. Now, I suspect if they get into this early retirement business, it most likely would be someone in that 1960 and later. But just be aware that there were different FRA based on year of birth. So at 1960 and later, we have a full retirement age of 67. So if we claim benefits prior to that, we're going to have a reduction. And I think that's all, good stuff for the national exam. I don't really think that you're likely to have to calculate the reduction, and in the example boxes here, it demonstrates what the reduction formula is. 5/9 of 1% for the first 36 months they're retiring early, and then it goes to 5/12 of 1% for up to another 12 months. I think I would want to understand the 2C highlight just above the example box, maximum reduction. If it's a client that has age 67 as their FRA, the maximum reduction in benefits for claiming early is 30%. And back when it was age 65, or for someone who has it at 65, FRA 20% was the maximum. So that's one of the areas they continue to tweak in Social Security. So I would remember those two numbers. And then a nice little one-off question here. The fact that, most of the focus is taking it early and what the reduction would be. But don't forget that if they extend, if they defer claiming the Social Security, they actually get delayed retirement credits, DRCs. And right now, for each year of deferral, it's 8%. But it stops at age 70. That's a nice little exam question too, is to test this piece, but also how many years can they do that? Only up to age 70. Can there be any kind of delayed retirement credit? Another element, one of the challenges to testing in Social Security is to keep the pieces separately. What we were just talking about was just taking their retirement benefit early before FRA. If that's the case, it also puts them into a possible reduction, another kind of reduction, if they continue to work and have earned income. Then there can be another test that comes into play where benefits could be withheld. And I think in the tax tables they have these amounts, but it's been upped to $16,920 is in the period prior to FRA. And the way that formula works is if their compensation, if their earned income exceeds $16,920, then $1 of Social Security retirement benefit will be withheld for every $2 in excess of that threshold. And now there's a special rule first year rule. I don't know how likely this is to be tested, but in that first year, earnings up to that point can be ignored, and as long as they earn less than what that first year limit divided by 12 would be, they could still get a Social Security retirement check the balance of the year. I think if this is tested, it's going to be more straightforward with just this $1 in benefit for $2 in earnings. In the year, and this would be RTFQ, when are they talking about in these dates? In the year that one reaches their full retirement age, the limit goes way up, and you can see, this year's limit there, and the reduction becomes a little more liberal. It's $1 in benefits for every $3 above the earnings limitation. So you have to pay attention to the year they're describing. Is this the year they reach FRA, or is it prior to that? And then you would know which one of these reduction formulas. Another possible test question is just the fact that they've got a lot of earned income, but they also are beyond their full retirement age. And in that scenario, if they're already at full retirement, there is no limit to the earned income they can have. It will not reduce their Social Security benefits. That's a really good exam question as well. So one of the areas of testing that could happen here is you're given all this data, this information, and you have to pick the optimal time to take the Social Security. So you've got to be sensitive to both the reduction factors due to early retirement, but also the earned income limitations if they throw that at you as well. And you'd have to look at, okay, if they wait till here, or till here, which one is optimal? That's a common type of question that you could see. I like these charts, and these are things that merit spending some time with. This one is just based on the kind of benefits: retirement, survivor, disability. Does the taxpayer need to be fully insured or currently insured? And I highlighted here one of the low-hanging fruit things to remember is when there are children involved, it's the most liberal. So if you see here in the survivor benefit column, when a child's involved, a spouse caring for a child less than age 16, or an unmarried child of the decedent worker under 18 or under 19, if still in high school, currently insured is the bar there. Whereas a spouse beneficiary would have, the worker would have had to have been fully insured. So this is a good chart to pay attention to, because you may have some questions where they're just saying who all could claim on this worker's record. And it's a pretty long list if you look at this of who all could be claiming benefits based on only one worker's record. Then another area that you may draw on your test day is the taxation of Social Security benefits. And this is a completely separate thing from everything we've talked about in this segment till now. This is just, okay, they have their benefits, but are they going to have to include it in their income for the year? And it's a little different. An important term to note here is provisional income. And provisional income is the worker's modified adjusted gross income plus 1/2 of the Social Security benefits. And there's a further piece to this that I've highlighted above, and that is the fact that for these purposes, MAGI includes tax-exempt interest. There are a few other things that are included, but the one that is likely to be tested is the fact they have tax-exempt interest, and you'd need to know to add that in with the rest of the MAGI and half of the Social Security. I think if you can practice, you can pick up these threshold breaks, but there could be up to 50% of the Social Security benefits subject to taxation, meaning they have to include it in their income that year, and there's your thresholds: 32,000 for married filing jointly, 25,000 for other status. And they're really hard on married filing separately. The thresholds are pretty non-existent with lots of different kind of financial elements, right? You've seen those in your other courses. So that's the first level, and then it could go up to 85% of their Social Security might have to be included in their income. And while I'm saying that, I'm thinking of in the tax session, we got out a 1040 and we looked at the first page and second page of the 1040, and we pointed out in that session, here's where Social Security is reported. It has two pieces. On one is just the full Social Security benefit, but then there's a B section to that line, and it's the taxable portion of Social Security. So it's being rolled in to AGI. So those thresholds are a little more expanded: 44,000 for a married filing jointly, 34,000 for other status. I think at a minimum, an easier exam question would be, what's the maximum amount of one's Social Security that could be subject to tax? It's 85%. That could be the question you see just standing alone, 85%. And then this is just a table to try to take you a little bit further and picking up some more detail on where those splits are. But I think they're fairly easy to remember with a little repetition in either writing it out or, again, just make sure you come back through and study these exhibits and tables and such. But at a minimum, remember the 85% piece. And I really like this too. If you just dove into this table and started trying to remember all this, it'll drive you nuts. So I'm glad it kind of comes later in the material. But it lays out the three different categories of benefit: retirement, disability, and survivor, and whom could possibly claim on that worker's record for those respective benefits. I don't suspect that you'd have to, maybe if you notice across the line there, the spouse for retirement 50%. I don't know so much about 32.5 and 35 and so forth. But maybe try to pick up on the fact that in retirement the spouse could receive 50% of the worker's amount at their full retirement age, at the non-working spouse's full retirement age, that is. Couple of maybe one-off questions further up there. 40 credits is the typical thing we're looking at. There are other ways to be considered fully insured. I think if you're tested on that, it's probably going to be the 40 credit piece, and a worker earns 1 credit for each $1,300 of earnings subject to Social Security taxes. A nice little question on that is the fact that it can all be earned in 1 month. They used to call these quarters, and you still will see some reference to that from time to time, 40 quarters. But it's just referred to as credits now. It's not referring to a quarter on the calendar. So a good exam question is, they've earned $6,000 in January. How many credits? And maybe the best question of that is, they earned $6,000 in January and then were unemployed the rest of the year. So how many credits did they earn? Well, they earned a full complement of 4, because it took $5,200 of earnings subject to Social Security to earn 4. That's a good exam question. Also, clear down at the bottom of this list, it is possible for a divorced former spouse of this worker to claim on the record. And that surprises a lot of folks, and there's some things that go along with that. You see the footnote: divorced spouse who was married at least 10 years to the worker. That could come in, but I think the more likelihood would just be the fact that they could receive a benefit. And then another nuance here, did I write that? Yeah, this red box note: all other beneficiaries on that lineup, there is an overall family maximum of benefits that can be paid. There is a limit. They would never reduce the workers, but when other family members are also receiving benefit, it's subject to an overall limit. but one exception is benefits being received by a former spouse are not included in applying the maximum family benefit limit. That's a nice little exam question. But then remember the big picture with the rest of them, and it would be on a pro rata basis. But I just think knowing the existence of a family maximum benefit and the fact that the divorced spouse isn't in the mix for that application probably will get you the points there. But study this stuff. Make this become easy. And if you have to choose, let's just say this stuff makes you crazy or it's just not soaking in, prioritize this then. If that's you, make sure you understand the retirement stuff. Maybe you won't know all of this on disability or survivor benefits, but make sure you know the retirement because that's the most likely to be tested. In disability, you'll read about some other things I mentioned, I think, in the insurance book session, how hard it is to qualify for the Social Security definition of disability. It's very restrictive. You might start remembering some of that, but make sure you really work hard on the retirement piece. All right, a lot of stuff. Again, in this session, I appreciate your attention and patience with this. I've just tried to give you a lot of possible points you can pick up today through this first pass. Just remember, though, most of you will be listening to this at the front end of your exam prep, so you have time to get into those books and get into these topics I've highlighted in these high five sessions. Ask a lot of questions, but also have the confidence of knowing that you're going to be back with a live review instructor, and the most highly testable of all these things will be reviewed yet again, both somewhat on an academic reinforcement, but also on some applications. So don't panic right now. If I just moved through this and you're like, oh wow, I can never remember all that. You can. It's just going to take some work. Let us help you. Send questions to me directly or through your instructor link. You got a lot of people at Kaplan dedicated to you passing this exam, so I hope you take full advantage of that. Thanks for participating in High Five. I hope you have the time or make the time to listen to all of the sessions because I hope that you've been able to accumulate a few more correct answers through the series. So study on, my friends, and let us know what we can do next to help you out. But you absolutely can pass this exam. Just believe that every time you dive into the material. You've got the right partner in Kaplan. You've got the right information. And every year we have hundreds of students that pass doing exactly what you're doing right now. So hang in there and keep pushing. All right. Look forward to working with you next time. Take care. Bye now.